Hello traders, this is Blake Morrow with ForexAnalytix, and you're listening to the week ahead video for February 23rd, 2020. Hope everybody's having a great weekend. We do have a lot to talk about. It was a busy week last week and volatility's picking up. Obviously there's some pretty big technical developments that have happened, and there's a lot of things we just need to speak about. But before I do so, let me make sure I mention that if you haven't tried out ForexAnalytix, this is the time to do it. $1 for 10 days. $1 for 10 days. So just try it out. And when you try it out, you're going to get the premium version, not the light version. It doesn't matter if you decide to try the light or the premium. You'll get the premium version while you're trying it. And make sure you download the mobile application. So whether you're using an Android device or an Apple device, make sure you download the mobile app and try it out for 10 days. It's $1. It's $1. Try it out. All right. So before I really talk about what had happened last week, let's talk a little bit about the analysis. Well, first of all, the coronavirus and some of there's a couple risks that have kind of evolved over the weekend. And if you were following me on Twitter or during the Face webinars, I just talked about we really have to start watching the coronavirus. Coronavirus and how it's developing outside of China. Obviously the numbers that we hear from China are more controlled probably, and so the alarming rate that the coronavirus is picking up steam in places like South Korea, that is alarming. The cases doubling in a day. Obviously what's happening in Italy is also a risk. And so for those of you, that are living in some areas that are picking up a little bit of steam with these cases, please be careful. Obviously that's what I'm most concerned about. I'm really most concerned about the transmission and how quickly it's picking up steam around other places other than China. And the coronavirus has actually brought the Chinese economy almost to a standstill. We're having a very difficult time. If you read some like the Bloomberg articles over the weekend about how a lot of Chinese companies specifically might be going out of business if this continues too much longer. So obviously a lot of stimulus and a lot of measures are going to be taken, but the supply chain disruption in pretty much every industry is going to be affected when you're taking the largest manufacturer in the world and grinding that country down to a standstill. And who knows how long it's going to take to get things back to normal. So we're seeing prices really be reflected in like equities, because the fears are becoming a little bit more real. And so between that and the election environment here in North America, in the United States, we have very polar opposite of Donald Trump, really Bernie Sanders making a lot of headway this weekend in the Nevada caucus. And if the market starts to price in the risk of a Bernie Sanders win, that's going to really disrupt the equity markets as we know them, and that's going to shift a lot of volatility in the FX market as well. Now, personally, I don't think he's a risk to Donald Trump. Personally, I don't. But that that does. I wouldn't have imagined that Donald Trump would have his extreme posture would have won the last election. So I'm not a political analyst by any stretch of the means, but what I need to point out are the risks that are associated with a Bernie Sanders majority as a Democrat, and that will put some of these moves that we've seen in equities quite possibly at risk moving forward. Now, if you look at, I just want to specifically take a little bit of time just to look at the S&P here, and just note that we hit a new high last week, and we put in a black candle, or a red candle, red or black. I tend to use the term black. We use black and white because of old school charts didn't have colors and they printed out in black and white paper. But a red or down candle, if it's followed up by another bearish candle this next week, that's going to be what we call dark cloud cover. And dark cloud cover is a bearish development. So next week is going to be very important for the S&P to maintain these levels. I think a break below 3,300 would be really a bearish event for equities. Now, I want to point out before I go into my own charts, because I want to be able to do a little bit of drawing for you guys. Just remember on ForexAnalytix, while you're trying it out, you have access to everything. So whether you're talking about macro analysis on a currency pair, and I'm just looking at the dollar index right now, candlestick analysis, basic technical analysis, harmonic analysis, Elliott wave analysis, whatever analysis type that you want, you have it here. But I'm going to be drawing a little bit on my charts, so that's why I'll pull them over to TradingView here so I can give you a little bit more specifics. Okay, so let's talk about some of these majors. I want to talk about the euro. I want to talk about what the yen did last week. I also want to talk about the peso, and then we're going to talk a little bit about the precious metals like gold. So let's first and foremost, let's talk about the euro. The euro squeezed at the end of the week. We saw some risk off, and so the euro caught a bid. On top of that, you had the manufacturing PMIs really came in very weak for the US on Friday, so that affected the dollar as well. Now, from what I'm reading from some of the bank analysis, is that we're heading into end of month and we're going to see some end of month dollar selling flows. So the risk right now is twofold. First of all, you have the end of month flows that if they prove to be dollar negative because of the equity market performance over the last month, you might see some dollar selling, and that might allow for the euro dollar to continue to squeeze. Now, the other issue that you've heard me talk about is the euro is the funding currency of choice. And we're seeing a shift in the FX market between the yen being the risk on, risk off barometer carry trade currency to where the euro might be that situation moving forward, in which the yen has really held that mantle for the last, or held that award on the mantle for the last 20 years roughly. So with the euro dollar being the predominant carry trade funding currency of choice, the euro is now, in my opinion, susceptible to risk off moves, meaning that if we see stocks continuing to go down, the euro may catch a bid as a result. Now you might think, oh, well, I don't want to buy the euro because look at the coronavirus is making its way into Italy kind of aggressively the last couple of days, but I don't think the euro is going to be as sensitive to developments that we have seen. That's the same situation we've seen in Japan for the last 20 years. I've been trading the FX market for nearly 20 years now, and before that I traded equities. And so when I bridged the gap to trade currencies back in 2001, predominantly one of the things that I learned is Japanese data doesn't care, or it doesn't matter. As a funding currency in a carry trade environment, Japan's data, I'd be like, oh, they had huge GDP beat or a big employment number or a bad employment number. It didn't really matter. The yen didn't move. The yen moved based on what stocks were doing. And I think the euro is going to reflect the same. So in other words, if the euro, which technically I look at it and frankly, I wouldn't mind selling some euros, but I don't want to do it here. And if we get above, you see this previous support here at 108.80, I think the risk is that the euro could squeeze back towards 110. Now, if you're itching to sell the euro dollar, I think the 110 level right here is probably the better level to look for. But I think that a move back above 108.80 to 109 is going to prompt a squeeze higher in the euro dollar. So will we get there? I don't know. But I wouldn't want to be short the euro above 109 because I think it might actually reach 110. All right. Now, for those of you that are looking to sell euros, like I said, I think maybe a move back to 110 would be a better location wise to do so. All right. Somewhere up here, 109, 70, 110, something like that. So that's the euro, and also I should point this out. If you go over to the weekly chart, this is a weekly chart of the euro, and let's let that populate a little bit. You'll notice that we are at a multi-year trend line here, going all the way back from 2000, basically intersecting at 2016, would take us right almost to where our lows were, and you could argue, depending on how you draw them, you're like, well, I want to draw it through that wick and that wick and take in account most of these wicks. And frankly, let me push this up a little bit. Right through these wicks, yeah, we're basically there. So, was that the cause of the euro bounce? Well, I don't know, but I do think that you could argue that we did hit support this last week, and we have, technically, we have respected it, and you can see that the relative strength is trying to come out of that, grossly oversold situation. Daily sentiment has been so obnoxiously bullish the dollar that it was due for the dollar to start pulling back a little bit. The question is now, how far do we go? And like I said, the euro, I think, is at risk of making a move back to the 109.50 to 110 level. Okay, keep that in mind. All right, I was also going to talk about the yen. So let's take a look at the yen. So here's the dollar yen. Now the dollar yen squeezed, and wouldn't this be crazy? And I try to speculate on this a little bit, but we broke this multi-year triangle breakout. It was massive. I got caught short. Now I didn't get hurt. I just got stopped out, but and for a very minimal loss, because I was trading it out against this 110 level, and when it broke out, it stopped me out, and I'm like, ooh, thank God it stopped me out, because this is a massive move. I actually ended up scalping it a couple times to the long side as we were breaking higher. But the fact of the matter is the dollar yen broke higher. Now, what's going to be really interesting, and I have to point this out, is especially in the FX market, old habits don't die easily. So if we see some, let's say stocks do come down, just for argument's sake, entertain the idea that the S&P actually comes off, like, let's say, like 2 or 3%. The question is, will the yen strengthen? Personally, I think it will. I don't think it'll strengthen as much, and I think this is like part of the months between now and months from now of the yen reestablishing itself as a different currency other than a risk on, risk off type of currency. But I think the risk of the dollar yen pulling back to, like, let's say 110 level is quite high. So if the S&P drops back towards let's say it takes a 2 or 3% drop from here, from current levels, I think that the dollar yen may fall a little bit, but it will find some support. So the breakout point was at 110.30, and if you let me delete this a little bit. If you hear my chair squeaking, I really need to WD-40 that, which I keep saying I'm going to do it, and then I get carried away doing other things. So if you take the dollar yen and you just draw a quick fib here, 618 comes in at 109.79. The 50% retracement's at 110.40. So I would venture to guess that this level here, right here, technically is probably a good area. Whoops, not there. Right here. The 50% to the 618, somewhere around here, this 110.40 to 110 is probably the better place to be on the long side of the dollar yen, in the event that equities sell off and the yen catches that old safe haven bid, which like I said, it's a process. It's not like there isn't a switch that gets switched in the FX market where people go, oh, the yen is not the safe haven currency anymore, or the currency that's bought during periods of risk off. The euro is. There's not a switch like that that's been flipped. It's going to take some time. So like I said, if stocks come down, I think the yen may strengthen a little bit, but I think it's going to end up finding some support, at these lower levels. All right, so there's the yen. Now, I also wanted to talk really quickly, which you guys have heard me constantly talk about, the dollar Mexican peso. Look, we came out of a descending wedge. We close back above this 1880 breakdown point. Let me clean this up a little bit. I'm going to go to a different feed just to kind of so I can draw a little bit more here. So you can see we hit the 127% extension of this move, descending wedge, which is a reversal pattern as it is. We tried to make it above 19. We failed, but you know where we closed above? We closed above this breakdown point here. Well, here and here, right? So this whole area, this whole previous breakdown point, we closed, basically above it. That now you're talking about, and let me draw something here for you. Now you're at risk of a bigger move. Let me get all the way down here, and let me make this a different color. No, that's not what I wanted. Clicked on the wrong thing. Sorry guys, just doing a little quick on the fly move here. All right, so we stopped at the 50% retracement. I personally, I think that a risk of the US dollar Mexican peso making a move back up towards like 1950 to 1980 is quite high. I mean, depending on how risk off we get. If the S&P sells off, another 2 or 3%, we might only make it to, back to the 200-day moving average. If we have an 8 to 10% sell off in the coming, weeks ahead, like let's say Bernie Sanders gets a big crazy boost, or the coronavirus doesn't look like it's losing any steam and it's picking up pace as we go into the spring. I mean, heck, we could end up squeezing a lot higher than what you see right now. One of the most lopsided positions in the market is long Mexican peso, meaning the market is selling dollar Mexican peso, euro Mexican peso for a carry trade. So if and it's like the most popular carry trade in the FX market. So if this position unwinds, which it's not going to do it in just 2 days, it'll take weeks to unwind a long Mexican peso position that's been capturing the carry trade. It'll take weeks. We could literally be trading up here depending on how bad the risk environment gets. And again, I'm speaking more of risk on, risk off, but coming out of this descending wedge is a bullish event. So I know Citi Bank, they're looking for a move towards 1950. Now that we've come out of this wedge, and you guys know I've been talking about this wedge for weeks now. So this is an important development. So I think if you're following the S&P and you're not even trading the Mexican peso, I think watching it is very important, as it will give you a good idea of risk on or risk off. Last thing I want to talk about, I know this video has gone on pretty long, is I want to talk a little bit about gold. Gold has rallied. It actually has gone further than I thought. Where's gold? Oh, there it is. Okay, so it's gone further than I thought it would in this move. I thought we would stop at 16.19, but remember, we have this pennant that points towards 1730. This pennant has been on my radar forever and a day. We have one pennant here, another pennant here, and that could take us towards 1730. And if you're like, well, Blake, that's way too far. We can't get up there. Yeah, we've been there before. This is not uncharted territory for gold. Okay, if you think about where gold's gone over the years, hold on. Draw that out. There we go. That takes us up to the 78% retracement of where we've been. And really, if things get out of control with a gold rally, I mean, could we surge past 2,000? Absolutely. Why can't we? There's a lot of potential risk that could manifest in the next 6 months. I mean, gold's not going there tomorrow, but I think there are, the risks that we could see, brand new trend highs in gold. And just remember, gold has been extremely resilient for weeks and months, and we've been talking about it. This rally really, this last rally started this last summer, where we completed this pennant. this pennant that took us over here to 1450, and now we've got another pennant that takes us to 1700 and change. And like I said, uh, Bernie Sanders takes the presidency in November. Gold will be trading well above 2000, in my opinion. Coronavirus continues to pick up steam, and the warmer temperatures doesn't slow it down. Yeah, we could trade a lot higher. So anyway, those are some risks that I see with gold. I'm not saying that I would be a buyer here necessarily. Technically, you probably want to wait for dips back towards 1600. But as relative strength is obviously a little overbought. But I'm just pointing out, potential in the coming weeks and months ahead. Anyway, just thought I'd bring that up because I know a lot of people are really focused on gold right now. So just kind of giving you what I view. Remember that you could obviously do analysis on all these other currencies, and really, if you want that analysis, just go to ForexAnalytix.com and try us out. $1 for 10 days. Guys, if you think this video has been beneficial and it's going to help you out this going into this next week, and you're watching us on YouTube, make sure you give us a thumbs up. Makes us all feel really good about producing these free videos for you every week. And I want to thank you for hanging. If you've made it this long, for 20 some odd minutes, I want to thank you for hanging out with me this long. My name is Blake Morrow. I'm with ForexAnalytix, and I'll see you tomorrow morning on the Face webinar. Have a great remainder of your weekend. Thanks.